Welcome to the Life Insurance Financial Education Podcast. We're pulling back the curtain on high cash value life insurance, revealing its role in a comprehensive financial strategy to help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Vaquera with Net Wealth Finance.
And normally Jing would be here, but she was a little bit under the weather. She'll be back next week. Today we're going to be talking about the importance of policy design. This podcast is all about high cash value life insurance, and the importance of how that policy gets designed can make such a big impact on the overall results. The design is key to the likelihood of success of your policy. Can the bad designed policies work? Yes, they could, but are they more likely to or less likely to based on how it's designed? Carlo, why don't you kick us off with a little bit of insight into the importance of the design?
So I want to start with a story of how I came into this business and into meeting James. And so I originally discovered this concept and started talking with a relative who I knew was a life insurance agent. And he got somebody he knew to design a policy because he did not know how, even though he's done lots of life insurance business, he did not know how to design for the purpose of what I was looking to do, which was high cash value. And the friend that he got to design something had no cash value in year one. And it right away just did not look good to me. So I just sat on it for a while, watched more content, discovered James's channel, saw some of the things that he had on his channel, and eventually met with him. And he sent me a couple of illustrations, and it was a completely different story. I think it was like 80, 90, maybe over 90% in year one on some of these illustrations. So it is a huge difference. Access to $0 in year one versus access to 90% of what you're putting in year one. That is a massive difference in your mental state when you fund a policy, that you're not losing access to all of your cash that you put in that first year.
That highlights a good point where I think a lot of agents that are going to come out and talk about a potential negative impact or the effort to try to justify the higher cost designs and how they minimize the importance of having cash value in the first year. As if you have access to that cash in the first year, you're just going to go spend it and lapse your policy. So you're better off paying for a more expensive policy that doesn't give you access to the cash early on. And beyond just having access to the cash early, what does that do to your cash later on?
Yeah, I think that in most cases, what that's going to do is it's going to really compound interest. When you lose cash value early on, you're not getting compounding on that early cash value, then it's going to have poor results in the long term over the life of that policy. So it is really, like James said, you can have these policies, do fine, but your likelihood of success is drastically reduced. And I would add to that with the fact that your minimum payment that you have to put in for the non-optimized designs, that's a much higher amount. So when times get hard, you might not be able to make that payment. Whereas with you have an optimized design policy, that minimum payment that you need to make is significantly lower. And that's powerful for being able to keep the policies in force. So I think that's just something to add for why we absolutely want to go with as optimal design for the person's situation.
I'm going to tell a couple of anecdotes to highlight the importance of design. These are real stories, real situations that happened. I was working with a client that they started the policy with another agent. They started multiple policies with another agent about 8 years ago. And it's the same product that I bought about 5 years ago. So I've had this one for 5 years. They've had theirs for 8 years. This is an IUL. When we look at the performance, the actual performance of the index options, nearly identical between their policies and my policy. The average return over the period that we've owned the policy. So they've got 8 years, average return, I think it was 6.53%. My 5 years, average return, 6.52 or 6.51. They were very, very close. These folks were putting in $20,000 a year into this policy. So they've put in $160,000 into this IUL over 8 years. And their cash value was about $30,000. They were wondering, what in the world are they doing with this? When they bought their policy, they told the agent they wanted something that would grow in cash value. It would be a high cash value policy. It's going to help a retirement supplement later on down the road. Now my policy, I've had it for 5 years. I funded my policy at $6,000 a year, just over $6,000 a year. Same average index return. We're invested 100% in the same index, which was a capped S&P option. My cash value was just over $30,000 also. So they put in $160,000 over 8 years and had about $30,000. I put in about $30,000 and I was right at $30,000. I was a little bit above that. So same cash result, wildly different results for the amount of money that we're putting into it. They were very, very unhappy with the results of their policy. And I'm very happy with the results of my policy. So a big difference there. And of course, just because where the policy is at right now is not looking good, it doesn't mean that their policy can't eventually work out. Now, their policy was designed with way too much death benefit. The expenses were very high. It paid out a massive commission to that agent in relation to the amount of money they're putting in. And so there was a lot of expenses in it. But when they bought that policy, the agent had them looking out 20, 30 years. And their policy was still on track to do what it was originally designed to do. But they're 8 years into it and wondering, where's all my money going? Do I want to continue funding this policy? And there's an emotional aspect to these things, to investing in general, where if somebody is putting a lot of money into something year after year after year, they want to see results. What I've noticed is that clients forget why they bought these in the first place. They don't remember that they were looking out 20 years from now and the numbers look good. And it could still get that way. They're looking at what's it done for me lately? And what is it doing in relation to everything else that I'm trying to do? Other investment options that I had to give up. And if it's not doing well, if they're putting money in and they're not seeing that result, they're likely to cancel that policy. I count that towards the likelihood of success. We have to think about the emotional aspect of investing. And is the growth of that policy, is the cash value that they have access to in that policy going to help them ride the emotional roller coaster of investments so that they stick with it? Now, that was this story about IUL. And I could say similar things about whole life as well, because we see all kinds of bad designed whole life policies. And I'm sure if you basically throw a stone, you can come across a financial advisor that wants to talk bad about any life insurance product and how you're better off investing in the stock market. Well, a lot of that comes down to design. Most of the policies do not get designed well. What's your experience there, Carlo?
Oh yeah, I mean, I think it's just clear, and the numbers you just stated. You put in 30,000, they put in 160. That's a huge funding difference, and you've had less time. Now, I think it is worth noting that they're likely still in their surrender period, so they're probably getting crediting, having some surrender charges applied to that giant amount of money. But it does not feel good when you know that you have access to a much smaller subset of your cash value. And absolutely, I think that mental positioning, that when you say I don't have any gains in this policy, a lot of people 8 years in are going to want to cancel. And so, like, I'm perfectly happy with my policies. I'm still funding them very heavily, and I think that plenty of people, if you fund them and optimize them properly, it's going to look really good, and most people will be very happy with it, even if they're still in that, prior to break even period, but generally that break even period is going to be significantly earlier when we optimize that design. And so that helps with how a person thinks about having that policy when they know that it's only a few years out from breaking even for the amount of cash that they've put in to the amount of cash. Optimally designed policies are just the way to go. There's virtually no circumstances where I would want anybody to get one of these all base policies. It's not that there's none. They're just very. And when we're thinking about cash value, we want to have, and that's really
Okay, so you've mentioned the blend. This is where we're pulling back the curtain on these products. There's basically two things that we can do to optimize life insurance policies for cash growth. One, we reduce the amount of death benefit that we're paying for so that it matches the amount of funding that we're trying to do, right? So our max funded policy is going to be paying for a minimal amount of death benefit. In the earlier example I gave you, they're putting in $20,000 a year, but the mech space, the amount of money they could have put into a policy every year was a lot higher than that. It was probably 3 or 4 times higher than that. It was not designed for the amount of funding that they were going to be doing for that policy. So they were paying for too much death benefit. So number one, we reduce the death benefit so that it optimizes for the funding. And then number two, we blend in some supplemental term insurance. Now, these are considered permanent products. Whole life, IUL. Permanent life insurance, it will be there as long as you make your payments. It's not going to just end like a term policy will, level term. So blending supplemental term, the reason we blend the supplemental term is because it gives us the mech space. It gives us the ability to fund it at a much higher level, but it doesn't add to the commissions. It is non-commissionable term insurance. It's the cheapest term insurance that you can buy out there. And when we do a design like that, we're minimizing the commission. Oftentimes, we're going to get paid 10 times less on commission compared to what a lot of these other agents are trying to sell out there. That savings goes directly into the client's pocket. That is money in their account as opposed to money that's going to me as the agent. And that's kind of our default setting around here. Anybody that works on my team, they know that we just optimize and designs the absolute best policies for our client without regard to what the commission is. I can't tell you how many policies I've done that I've done some very, very small policies where I maybe make less than $100 commission. That would be a kid's policy with a particular carrier. I'm not making hardly anything on that. And I still got to spend almost the same amount of time as to sell a regular adult policy. But I don't even think twice about it because that is the proper design for what they're trying to fund it at. So we can sell policies that will grow in cash value that people are putting in $30 or $50 a month into. Like that's almost unheard of outside of maybe a whole life policy that might take 10 years at $50 a month to grow some money.
Yeah, and I think that's a really great point that we can design policies that can have extremely low funding levels when we do these optimal designs. Now, generally speaking, this really low funding is not going to be as optimal as getting closer to the max blend. So James talked about some of the basics of that we want to blend in term. So each carrier that offers the ability to blend is going to have an optimal ratio of that blend of term to base. So some can be as much as 10 times the base policy, and you can have a significant portion, 90 something percent of the death benefit is coming from that non-commissionable term. And that's a lot of power in reducing the costs and reducing that commission so that that commission based on that much smaller amount of death benefit but we're still able to put in very large amounts of money. Now, not everybody's going to actually, most people who are relatively young and healthy probably are not going to fund at that high of a level. But sometimes when we have this cheap term, we might just keep it on there, because when we run the numbers, we can say, well, it's going to cost you this much over the next few years. Do you think there's a chance that you'll fund it? Maybe your income will increase. These are things where we can have some space to fund it a little bit more later on without having to open another policy, and maybe a funding level. So I think that that's another important factor when you get into using the non-commissionable term. It's really cheap. We do have that opportunity to have a little bit more death benefit than you actually need for today's income level, but still accounting for tomorrow possibly.
Good points. There's been a number of policies, and I will often illustrate this with a client where we'll dial it down so the death benefit is absolutely minimized for the amount of funding that they want to do. And if that leaves us with any space where we can add in some more of that supplemental term insurance without increasing the other expenses in the policy, it might make sense to just build in a little bit of mech space that might get used in future years, because the underlying expense is very inexpensive. Case in point, I had a client that we went over and over looking at what he was doing. He was going to fund $6,000 a year into a policy, and we were trying to leave a little bit of extra space. We talked about it a bit, not a whole lot, but we talked about it a bit. And ultimately he decided to design it for $6,000 as the mech space. Fast forward 1 year. At the end of his first policy anniversary, he comes back and he says, "This is great. I want to put in $12,000 instead of $6,000. Oh no, I said. Had we just built in that extra space a year ago, the extra expense for that first year might have been $100 just for the extra cost of insurance. $100, we could have had an extra 100 or 200,000 in death benefit on there that would have left enough mech space that he could have just added money in. Trying to add it later would have added another $1,000 in expenses. And there's no way that I can avoid that. That's just how it works if you want to increase it later, because the insurance company is going to need to go through underwriting. They're going to have to approve it. And essentially that kicks out more commission, and it's unavoidable. So we really want to try to dial this in, but take at least the next few years into consideration. If you think there's a chance that you might want to increase your funding, let's take care of that today, because oftentimes we can do it at a very, very little cost if we're not already at a scalable level of base face amount to supplemental term.
Yes, and I think that if you're not hitting that max blend and we have room for adding supplemental term, it is just the costs are very minimal, so that is a really big consideration. Now, if we're talking about needing to add base in order to add more supplemental term, then that's a different story. You can end up adding more costs there. It depends on the situation, but I think most folks are not usually in that situation where they're at that max blend and max funding at that max blend.
And that supplemental term, it's annual renewable term insurance. So it's inexpensive if you're young. It's more expensive. It doesn't really get expensive until you get into your 70s and your 80s. So there's a lot of years that we can have that supplemental term blended in there, and it's really not going to be a very expensive cost. Most of the time, we're going to be getting rid of that supplemental term long before we get to 70 or 80 years old. It's going to serve its purpose. It's going to allow us to shove that money in early, get the compounding growth for decades, and then we just stop paying for it before it gets expensive.
Yep, exactly.
So I have another anecdote that I'll tell you about. It really highlights the difference between, let's say, a high expense design and a low expense design. I have this video on my channel I put out last year. I was working with somebody who was going to do some premium finance. They were working with a different agent. They got a premium finance quote. They had already done an application. The hangup that they were having with that policy was the expenses. It looked very expensive. Now they were going to be putting in, I think it was $50,000 a year, and the finance company is going to kick in, I think it was another $200,000, something like that. It was a lot of money that this person was going to put into the policy. Inherently, if you're not doing a blended design, that is going to have a massive amount of expenses. And that was the case with this one. Well, this client happened to stumble across my videos. He reached out to me, and I did some illustrations for them. And over the course of the next decade of starting these policies, same amount of money going into it, it's about $200,000 less in projected expenses than the design that they were going to get. Now, our premium finance clients, that means you're going to be using a bank or a lender to leverage some of your dollars. You might put in $50,000 and they put in 4 times that much. There's a good reason that some clients might do this, especially if they don't have liquid assets, but they have assets that they would like to get some life insurance coverage on, and they want to try to earn more inside the product that they're getting. They're giving up control of the product by doing premium finance, but they're getting the use of other people's money. Well, if you check out that video, we have a much better way of doing that type of thing. But at the base level, we can do premium financing. I can do premium financing just like other people can, but I reduce the commissions on that. I do a nice blended design that lowers all of the expenses. And we were able to illustrate a $200,000 savings. That was massive and a huge win for the client.
Yeah, no, I think that's an incredible story. I think especially as you get to these really high funding levels, if you are not using optimized designs, the numbers get very large. Like you said, $200,000 in expenses is massive. And I'd imagine that probably actually increases over time. And as you compare the difference in what you can get with the gains on having the higher cash growth at those early years without having to collateralize externally. And I think also a consideration with premium finance is you have the possibility of, if your assets, your collateral, or if it doesn't perform as well, you may need to add collateral to that premium finance.
Yeah, there's definitely a lot of risks when it comes to premium finance. You could get a margin call. Essentially, you need to add collateral. Interest rates could be increased. They're variable loans that get offered by premium finance companies. So there's definitely some risks to look out for in those. And certainly if anybody's considering that, I would hope they would reach out and talk to us before they do it. See if we can save them lots of money.
So I've got some videos on my channel that are walking through some design comparisons between optimized policies and funding levels versus not optimized policies, and for whole life. And when we get into the numbers of what we're actually talking about here, the optimized policy, for example, in one of these is the estimated commission is $1,300, and the minimum premium is $1,900, let's say. Comparing that to the worst design, the not optimized design, we're talking about a $28,000 commission, a minimum premium of $24,000. So that's a massive difference. It is more than 10 times the minimum premium that you have to put in.
Just to be clear, those 2 policies that you just talked about in your spreadsheet have the same funding capability.
Yes, the same funding capability, and we're talking about a massive commission difference. That will also very often be the case for somebody that's younger. So this did these around a 25-year-old, and funding difference, you can have the same funding, but a huge commission difference because that is a young person who has cheap insurance anyway. The cost of insurance is much lower, and you can fund it at the same level and have less than a tenth of the commission going through. So it is a really big thing when we're talking about optimizing these policies. That's optimizing these policies for you, the consumer, and not for the agent.
What about the people out there that would say, there's nothing wrong with paying a commission? Everybody's got to eat. What's the ultimate impact of the two design differences there?
Our goal is to do well for our clients so that we can do more business. And that's really what it is. And we don't have to get it all in one policy. When we do plenty of business with other folks who are going to have really great success in their policy, and they're going to tell other people about it. We have commissions as well. It's just when we significantly reduce them, it's better for the client, and that's really the important factor. And there's nothing wrong with that commission. It does take work to learn about all this stuff and do all of it, but what we want is to help people to have high cash value in their life insurance so that they can tell other people about this amazing product or these amazing products.
And ultimately, what is the difference to the client? Give us the examples. Where are those things at 20 years or 40 years down the road?
So in this IUL example, that $28,000 commission resulted in zero cash value available for 3 years. So that's what that $28,000 commission means for that client. 3 years, zero cash value is accessible. Whereas in these optimized policies, we're looking at so this is a $25,000 a year funding. So think about funding $75,000 into a policy and being 3 years in and having access to zero of that. That would not feel good. Optimized policy, $20,000 available, accessible in year one. And by year three, accessible $73,000.
Okay, so those are great in the early years, but surely the higher expense design will catch up at some point, right?
No, it doesn't even come close. Specifically, when we're talking about IULs, the compounding, especially if we're talking about a young person, and that amount of compounding, the difference in the late years is massive. So we're talking about millions of dollars of difference in value as somebody reaches retirement.
Okay, so give me the concrete numbers at age 65 for those policies. What's the difference?
So the optimized policy at age 65, same funding level, is $4 million of cash value difference. That's an insane amount of money. It is a lot of difference in cash value, and they funded exactly the same over that period of time. So that's $4 million out of the client's pocket if they go with one of these poorly designed policies.
Now, surely you're assuming 12% average growth like Dave Ramsey would probably do, right?
When I ran these numbers, we ran it with the index returning 6%. We like to be conservative with this. My own policy is doing better than that this year, but we want to be conservative and realistic about the long-term gains over the life of this policy. So I think 6% is pretty realistic for an IUL. And so it's not crazy numbers that some people in the financial industry will say, oh, the market always returns 12 or something like that. We're not doing that with these policies.
Even at 6%, the numbers look good in these. When we design these policies with low expenses, we don't have to illustrate them at the maximum. We don't need to reach for every single dollar in order to make these look good. Like, they work really good when we assume 6% growth. And the client's going to be really happy. And if it outperforms that 6%, great. We actually expect to beat those numbers. But I don't want to illustrate 7 or 8% if it would even let me, and then have it return 6% and nobody's happy.
Absolutely.
All right, so we've talked mostly about IUL. Most of our examples have been about IUL. I want to give a quick story about whole life. This was from one of my very first clients that I worked with. Business owners, they wanted to put in $125,000 a year into a whole life policy. We designed a really good, low expense policy, had a lot of cash value early on. And of course, because we had a lot of cash value early on, it's going to grow and compound quickly. And it gives a lot of liquidity so that they can go do other things with those dollars. unbeknownst to me, they also started policies with a different agent that was supposed to be for the death benefit. They knew that they were getting a design from me that was for cash value growth. Well, we happen to get plenty of death benefit for the design as well. But this other policy that they set up, they were going to do $30,000 a year, and it was supposed to be for death benefit. Fast forward 1 year, the client revealed to me that they had bought this other policy. It was supposed to be for death benefit, $30,000. They were really happy with the policy that we designed and the cash value that was available and how it was growing and the projections. So much so, and they were disappointed in the other one, so much so that they were ready to cancel the other one in order to start another one that was an optimized design. After that first year, they looked at the other one again with a realistic eye and thought, wait a minute, in the high cash value design, I actually get more death benefit and more cash value than this other one that I bought that was supposedly going to be for death benefit. When you cancel a whole life policy that's built like that other one was, you get no money in the first 2 years. No cash value, or almost no cash value. So essentially, he ran the numbers, and it was better for him to take a $25,000 or $30,000 hit by canceling that policy then, rather than continue it, and instead start focusing that money towards a high cash value design. Pretty crazy stuff.
Especially as we get to the ability to have blends, and that's a very healthy funding level. Both of those policies would be, $30,000 or $125,000. Those are pretty good funding levels to have pretty optimally designed whole life policies. So I think that in the end, that is another thing. We can have short-term higher death benefits because we're doing a blend with term, but in the long term as well, with whole life, the way that we fund these heavily is through paid up additions. So we are buying more paid up additions in a whole life policy that will eventually add to the death benefit. And you'll have a higher death benefit when you're actually more likely to pass away because of all of that paid up additions over the life of the policy that will just grow your cash value along with your death benefit.
And essentially with all these policies, we can really design them to match almost any funding level. You don't have to be putting in $20,000 or $50,000 a year in order for these things to make sense. Like I said earlier, we could do as little as $50 a month in some policies, and it will make sense. It will grow in cash value. I know my clients range anywhere from, I think, $30 a month all the way up to many hundreds of thousands a year that they're putting into their policy.
That is the beauty of optimizing the designs. When we put in a blend, we can still have cash value growth, and people can be happy with those policies, and they can be great savings vehicles for folks who may not have the opportunity to save elsewhere with these lower funding levels that still have cash value growth.
I think we pretty much covered everything that we were trying to cover today. Do you have a call to action for our listeners this week?
So I would say that reach out to one of us. I think that somebody from our team can help you in your journey to learn more about this or check out some of our content. I specifically do have some content on the comparison of optimal policies and poorly designed policies. So check out some of the content on my channel, and James has videos on this. Various creators have content on that, and really looking at optimized policies is, when you compare them to the poorly designed policies, it's game changing.
I'll second that. I would say the call to action is hop over to YouTube or some other type of visual platform where you can check out videos where we go over actual numbers, and you can see in a spreadsheet or you can see in an illustration what a good designed policy will look like. Whether you're currently working with an agent and you've got an illustration that you're not too sure about, or you're just dipping your toes into this, go check it out. There's a lot of value in seeing what's possible out there before you go and talk to another agent, or in getting a second opinion. So if you're already working with somebody, maybe we can help you make that better. I can't tell you how many times I've met with people who have gotten an illustration from a different agent and they have a good relationship with that agent, but they just feel uncomfortable with that design. And I just show them how to do a better design and I give them the illustration. I say, take this to your agent, have them design the policy like that. You don't even need to buy from me. I'm just going to be glad you're getting a well-designed policy. I've done that many, many times. So reach out to your agent or reach out to one of us. Get some more details. These things can be really good if they're designed properly. And we do want to see people have the best chance at success, whether they're our clients or somebody else's. And with that, we're going to wrap it up this week. So be sure to join us next week. I'm your host, James Barber, your Oregon Cash Flow Pro. You can find me on YouTube at Oregon Cash Flow Pro. I'm licensed in nearly every state for life insurance and annuities.
And I'm Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at SHAPNIN. And we work with clients across the country as well.
Take care. We'll see you next week.
Thanks for watching.